Good morning, guys. I see there are 9, 10 of you waiting already, so that's great. We've got Kenneth here and Max as usual. Today's gonna be a little different episode. We're not gonna get into too much TA in this one, but we're gonna talk about investing. I wanted to really bring Kenneth on actually after we had Gareth, especially because one, he brings a different perspective to what we do because we operate a lot as day traders, which is something that is kind of a risky endeavor in itself. So you really have to compartmentalize and have a diversified portfolio, in my opinion. And one thing that I wouldn't say we lack in, but one thing that we're not, I wouldn't consider us experts in, is going into traditional markets and investing, especially for the long term. Because Kenneth here, that's what he does. So Kenneth, go ahead and introduce yourself. Tell us a little about yourself and your background.
Sure. My name is Kenneth. I live in Washington, D.C. I'm a self-taught stock trader, mostly swing trading, although in the last couple of years, I got more heavily into day trading. And I've been an investor since I was like a late teenager, like 18. I started getting into some stocks that I was looking around and seeing all my friends were getting, iTunes gift cards, and everyone had like the first generation iPod. And I was like, I should be buying stock in this company. So that's kind of how my investing got started. I didn't go to college. I wanted to be a pro wrestler. On the first day of class, I got thrown over the top rope and I landed on the cement and I broke my back. So that was the end of my pro wrestling journey.
It's funny you mentioned that. I have a Macho Man Randy Savage shirt and I almost wore it for this interview because I was like, Kenneth, Kenneth would really appreciate that.
Yeah, I have one too. We should have coordinated next time.
Max actually had a pretty interesting question on something you'd mentioned earlier. He was reading a book on investing, and I think it ties into the premise of what you were just talking about with the iPod. Max, do you remember? We talked about it a while ago.
So the question was, so I read One Upon Wall Street by Peter Lynch, and he literally said, in his way to give people advice into how to get into the stock market, is when you go to somewhere and you go to a restaurant or a chain or a hotel and you say, wow, this is an exceptional service, you should invest in them type of products. But my question to you was, what if which we're going to get into in a bit, because you're going to go to like how to check out all the debt and all that, I believe. So my question was, if you really wanted to buy this, but then you were to go into the fundamentals behind it and they weren't all that, what would you do? Like, how would you approach it? Because if you really wanted to invest in it, but then you went a bit deeper dive into the fundamentals and they weren't that good.
Yeah. So, it really depends. I mean, sometimes just because you love a company and just because the people love it doesn't mean it's worth investing in. And other times, because the people love it, it's absolutely worth investing in. So like you said, the most important thing to do is go over the fundamentals and the financials to look before you actually invest. Just because you love Chipotle and just because there's a line outside of Chipotle every day, well, I shouldn't be using Chipotle because their stock is actually crushing it. But there are examples like Snapchat or Peloton. People love those things, but you look at the fundamentals, you look at the facts behind it, and these companies are dropping. They're losing money. Their debt is increasing. And these are companies that are really in trouble despite the fact that they have a loyal fan base. So it really is kind of like a okay, you see it and you go, wow, look at the line outside of this Chipotle every day at lunch. Now let me go look at the fundamentals. Let me look at their financials and see if it actually matches up. And then you can decide from there. But I wouldn't really just be like, oh, I like Peloton, I'm going to buy stock in Peloton without actually looking.
Okay. I have a question. In terms of the fundamentals that you do look at, do you have like a general list? Like just if you were like, I want to see these statements, what are those, like off the top of your head?
Sure. So I like to see that revenues are increasing, not just quarter over quarter, but like year over year, because things can change in the short term, like what we're seeing right now. So you can see like, oh, last quarter was bad. Oh no, but it should, like, the last quarter shouldn't really scare you. You should be trying to get the bigger picture over like many, many years to see that their sales are increasing, that their net income is increasing, that their free cash flow is increasing. Total assets, I like to see that their assets are increasing as well. And I also look at total debt, because even though you would like to see that number coming down, for a lot of companies, especially new companies or tech companies, taking on a little bit of debt is a good thing, because it means that they're growing and they're building out their company. So, I look at that. I like to I think those are like pretty much the big ones that I look at.
In terms of companies, this kind of ties into what's going on right now. We've had artificially low interest rates for quite some time before the rate hikes. Do you think that caused companies to take on more debt than they probably should have? Do you think that's something you're seeing across the space?
Oh yeah. Look, I mean,
Like,
it's basically free money. Like, if you're paying 0% interest or like less than 1% interest on your loans, why wouldn't you? Like, why would you take your free cash flow or your reserve money and spend it when you could just get a loan for, as much money as you can possibly imagine for like the smallest amount? And now this is also, when you see interest rates rising, this is when these companies get in trouble, because they've got limited budgets, they've got limited assets, especially if they're new companies, and it becomes way harder for them to borrow when their interest rates are huge. So you can see tech companies especially see slowdowns because they're looking at it going
hard, like very hard.
We can't afford to borrow all this money when the interest rate is 6% or 7% or whatever it may end up being. So we see slowdown.
Yeah, no, that makes perfect sense. One thing I wanted to mention before we get too far in, because I failed to do right out the gate, but we're in the first 5 minutes. Kenneth has a lot of really good free information on his TikTok, which is Trade Invest Simplify. And then your YouTube channel, is that Trade Invest Simplify as well, or is it Kenneth Suna?
It's just Kenneth Suna.
Kenneth Suna. Okay, we'll have the links in the description down below, but he's got playlists dedicated to a lot of this stuff. And that's kind of been your passion. So I wanted to bring you on, because there's very few people that put this much effort into something like this for free, for the public, for people just to enjoy. So I wanted to see if we couldn't push any additional traffic your way that we could, because we have a lot of crypto people, and I love crypto. I don't know what your take is on it. I'm going to ask you obviously here in a second, but I do think that a lot of people make the mistake of they only invest in crypto. And one of the biggest issues with that is Bitcoin, I think, is going to be around for a while. I think it's safe to say. However, it's still a really risky market. And if Bitcoin's considered risky and it's the most stable of them, you got to look at the other ones and go, it's kind of a boomer bust thing where you can really get stuck holding these, kind of like you were saying, like companies that maybe took on a lot of debt, don't actually have any real revenue coming in. And it was just a hype cycle, and they just, exit stage left, and you're just left holding something like that's worthless, like JCPenney stock now.
Right. Yeah, exactly. Yeah. It's a concern, definitely. I mean, like, you have a lot of new investors who got into the space because of AMC or Dogecoin or GameStop. And like, on the one hand, it's great. They got interest in something. On the other hand, a lot of these people are going to get wrecked, and they're going to walk away saying, oh, investing isn't for me. I tried it when I was younger. I lost a lot of money. Not realizing like what they were doing was like largely speculative or gambling on stuff like this. But they'll conflate it, and they'll be like, well, it's the same thing. It's the stock market, it's crypto, it's investing. And they'll get crushed. I'm also looking, because I have my phone down here, just so everyone knows I'm not ignoring you. I'm checking the chat. But you have to be diversified. And I think so many people do it the opposite way, because people have money problems and they want to get rich quick. So instead of putting the majority of their money in safe and boring stuff, and then a little bit that they're willing to lose in like really high risk speculative stuff, they do it in reverse. And they go like as heavy as they can into really high risk, and then they neglect the safer stuff. And like with crypto, who knows what's going to end up happening, and if it's going to get
regulated. We don't have regulation yet. It's like, well, anything could happen.
Yeah, anything can happen. And so for the people who, like, I get it if you're young and it's exciting, like, yeah, but like, what's your backup plan if it gets regulated and if a lot of these coins go away? What's the plan? And like the stock market, whether you like it or not, like I'm in it and I invest in it, but I don't like a lot of these companies, but I'm still in it because that's the only choice we have. Like, what am I going to do? Work for the rest of my life? So,
one thing I've caught you doing a lot of on TikTok, which I think is great, because I preach this, is you live below your means. Like, you actually have a budget, and it makes this affordable, because a lot of people want to be like traders, for instance. So we get a lot of people who want to be a professional trader. They don't realize that living below your means is going to afford you the ability to learn as you go and have a few mistakes, because it's going to happen. There's going to be unprofitable times. And if you're not prepared for those and you're overextended, kind of like we were talking about with companies, borrowing money, whatever it may be, installment billing, car payments, it's like, you can find yourself in a bind, and this isn't as enjoyable as you thought it once was, and then you actually probably regress in it. One thing I wanted to ask you about is, you mentioned you've gotten into day trading more, which I imagine the volatility in the stock market's been great, because it wasn't like that in the past. It seems like this past like few years has been pretty wild. How do you allocate your funds? I know everyone's situation is different. When you allocate to a day trading account versus like investments, like, is there a percentage you go off of, or do you just go off what you're comfortable with?
I usually just go off what I'm comfortable with. I always try to keep like a fair amount of cash in reserves, like what we were talking about. So I'm not worried about like bills and stuff like that. And I live below my means, so that's another element that I've removed, is like stress about money. But when it comes to trading, I just kind of wing it. I just try not to go below a certain amount of my cash, so I'm financially in trouble.
No, that's fair. That's a good, it's just a really good thing to do in general. Like, I always tell people to sit down with themselves and like literally write down like a budget and what your goals are, and like make it realistic. Because more than likely, when people start something like trading, they're going to fail initially, or there's going to be moments where they are thinking that they're going to fail. And if they don't have something written down to reflect back on, to say, okay, I could tweak this and maybe do this better. And I think the same implies with investing. So I can imagine that there's probably a lot of people that get into investing and then quit. They stop doing it because it's like you said, the light at the end of the tunnel is further away than they were expecting. It's harder than they think. There's downturns in the market. And then sometimes there's not even a downturn. They watch the news too much. It's like you watch the news and the pundits go crazy, and it scares people out of the market and scares them out of their investments. Sure. Just one of those things where I would always sit down with yourself. One thing I am going to highlight a comment here is this guy. He's a regular on the channel, OC here. And he put in that, he goes, I don't know why so many people mock a 9-to-5. And I don't think Kenneth was mocking anyone that works a 9-to-5. I just think that, he's like me. I don't want a 9-to-5. Sure. It's just not for me. I've done it. But in terms of that, you have to think, I believe he's a veterinarian, and I imagine he loves what he does. He's been in our group on and off for over a year now.
With Pet Doctor,
yeah, if you were a pro wrestler, you'd probably be okay with having a job, right? Because that's what you wanted to do. But it's like him; he probably loves his job. Not everybody gets to do that, unfortunately.
Yeah.
But if they invest correctly and they use the time, that's what I wanted to highlight, is that you can get information like this for free, and you can maybe cut that time down and enjoy some of your years. Because it's not mocking a 9-to-5. It's just doing the math in your head, going, do I really want to work at a job till I'm 65 years old and then enjoy 10 years? Left.
I mean, the average like age of death is like mid-70s, like globally. I think like the average, so what, you retire when you're 65, but then your knees hurt and your hips hurt and your back hurts and you can't really travel the way you wanted. I'm seeing his follow-up as well. Like, but a 9-to-5 is the reality for a lot of people, and trading, it really isn't for most people. Like if you have a family and you're responsible for the mortgage or school, or you have elderly parents that you're taking care of, or pets that need us, you need guaranteed income coming in, trading might not be for you, and that's okay. Like, it doesn't have to be for everybody. I just when I was working in the gym, I was working at the front desk at a gym, and I was making $8 an hour. And I was just like, I can't do this forever. And like, I was getting written up for not tucking my shirt in. Like, really, is this what we're doing? Like, like, these are all like adults, like standing at the front desk with a clipboard going, your shirt's not tucked in, I'm going to write you up. And I was like, I can't do this. Like, because the next step up was they wanted me to be management. And I was like, I can't imagine standing at the front desk, like yelling at someone for not tucking their shirt in. So I had to find an alternative.
Fair. I got written up for not putting a name tag on when I was like 22, still working at a bar, getting through college. Yeah. And I just remember being like, I don't work at Best Buy. That's what I told him.
Right.
He was like, do you want to get fired? And I was like, not really. I do need the income. But yeah, I totally agree. I get that. We do have one question that is actually a pretty good one here from Nick. Nick actually found us through traditional markets, kind of. So I'll highlight his, but it's, do you prefer single dividend companies and build your portfolio with 3 to 6 solid companies like Starbucks, Home Depot, etc.? Or do you prefer big ETF dividends like IVV, DVY, and VXUS?
Actually, this is really funny because I just posted a TikTok about this literally last night. breaking down. So someone said that they wanted to create their own like universal basic income. And he was like, I need $12,000 a year. How do I do it? And I broke it down a couple different ways. So one way was a mix, like Nick is saying, of a couple of funds, like a real estate trust, a dividend fund, and then a couple dividend paying stocks. And the other was just going like all in on the Schwab high paying dividend ETF. And it's about $150,000 cheaper to pick individual high paying, high quality dividend stocks, not garbage, but like high quality stuff. It's cheaper to get the mix than to go all in on just the fund. But it really depends on your own personal styles. Like if you don't want to manage a fund or a portfolio, if you don't want to sit there and pick different stocks, then funds are totally fine. It really is a personal preference. I personally prefer a mix. So I have my really high paying dividend companies and I have my index funds.
I've noticed you have a series on TikTok where you break down how do you make $1,000, I think, a year on dividends alone from X company versus another company. And usually they're in the same vertical. It seems like they're competitors. So I find that really interesting. Which one would be the best one to invest in? That doesn't mean that the stock's going to appreciate more over the other one, but the dividend is what you're after, which I thought that was really cool. So those are on his TikTok. Do you put those on YouTube as well? Do you air shorts or how do you do it?
Yeah, they're all in shorts, and I have some dividend playlists on YouTube too.
Yeah,
that are from TikTok, so they're shorter.
That's I have awesome. One last question. Well, I actually have two, but I'll get the main one in if we're going to cut it short. What would be your advice for someone that has literally zero idea in getting into the stock market? I don't even know how to buy a stock. The only one place where I know to go is eToro. You know, I've just only done crypto.
Sure.
Where would I go? I'll go on. I'd be looking at these dividend type stocks and that type of thing, but I have no idea where to go.
So I live in the States. You're in Dubai, right? But I have a TD Ameritrade account. But basically, any major brokerage is going to be fine. The first thing I would do if I had like really no idea what I was doing is I would get a broad market S&P 500 index fund. So like the one that I own, the symbol is SPLG. VOO and SPY, they're all very similar. They are exactly the same thing because they invest in the S&P 500. So I would buy one of those, and I would buy a high-paying dividend ETF like the Schwab. The ticker symbol is SCHD. And not that I'm giving financial advice, but that's what I would buy. If I had no interest in anything and no knowledge, I would at least have that foundation. I think the mistake a lot of new investors make is they're like, what stocks do I buy? What's the best company? What's this? And they get overwhelmed, or they go on TikTok and like, I make a lot of videos for beginners where I'm like, here are the 3 things I would do if I was new. And immediately the comments are flooded with like, well, you didn't mention covered call, 3 times leverage ETF. And it's like, dude, that's too confusing. Like for a new investor, stop it. Like an index fund and a dividend fund, get the foundation, because the odds are you're gonna forget about it, or you're going to lose interest in it, or you're going to move on and do other things in your life. And it's always going to be there reinvesting. You're always going to be getting dividends, building and building and building. So at the very least, get that foundation. And then 2 or 3 years down the road, if you find that you're still really interested, then you can start exploring individual stocks, growth stocks, tech stocks, speculative stuff. But bare minimum, an index fund and a dividend fund is what I would do.
And then the second question, you mentioned at the start you could find the debt of a company, the cash flow, I believe, of the company, and there was a couple more. How? Where'd you go for that type of information?
So you can literally go on any finance website. Marketwatch.com has great fundamentals. So when you type in a stock on their screen, it'll show you like charts, fundamentals, and you click on that, and you can just literally see earnings, revenue, debt, cash, assets. You can see it all there. Yahoo Finance has a great one. MarketWatch is great. Basically, any finance website will have.
I did not think it'd be that easy.
Yeah, it's super easy. And I have also to plug my own YouTube channel. I have walkthrough videos.
I was going to say, definitely let them know if you have. Yeah, because I imagine you have a series where you go over. I imagine there's certain debt to earnings ratios you want to see, things like that on a stock. And I imagine you go through that and let them know, hey, this is what you're looking for as a general ballpark rule. You want to see, X, Y, and Z in terms of these lining up. And that's a good sign. So that is, it's too much information to put in like one stream, but that's why he's got a playlist, guys. So make sure you're going over to his channel, subscribing, and then looking through that stuff if you're interested in this, because I think you made a great point. People make it harder than it needs to be. And that deters people from sticking with it or even starting. I think a lot of people get like this huge idea that they're going to do it and they're going to get this retirement, and then they just never do it until they're like 40 or 50 and they're like, oh fuck, I have no retirement. Excuse my language, but it happens all the time.
I get about 2 DMs a week on Instagram from someone late 50s, early 60s going, how do I start?
Oh man.
Like, dude, that's not like, this is not what I want to be doing. Like, that's why I started this TikTok for people who are much younger. So they don't end up in, like, I don't want to be the bearer of bad news. I don't want to be the guy telling like these 65-year-olds that have worked hard their whole life that they're basically fucked, because they are. Like, the amount of money you would need to live off your dividends, you can't afford it now. No one can afford it, to invest.
Not the everyday person. No. Yeah. And at that point, if they can, they probably don't need to put any money in there anyway, because they already have that lying around. So
exactly.
It's one of those things where it takes time to build that up. And one thing I used to do is, he was asking about brokerages. What got me into the idea of like investing and speculating, if you want to call it that, was I was like early 20s. And right then the apps came out like Stash and Acorns, where like it took your loose change and it rounded it up into whatever index fund you wanted. And that I thought that was just ridiculous for the longest time, but I did it for a full year when I was like 24. I had like $2,000 in there, from just roll-ups. And, I think I also invested like a few dollars every week. It like auto deducts or whatever. The only thing I would say is be careful with those. I found out later that they charge, a fee, and their fee is, I wouldn't say it's substantial, but just to have the app in the account, they're charging you like $3 like a week or something. Whoa. And I was like, oh yeah, it was high. I was like, oh man, this almost negates, anything that I'm doing here, except, the stock market went on a massive run. So it actually ended up being okay. But it was just one of those things where that did catch me off guard. So just be careful with those. But people are trying to make it easy, get involved. Kenneth is obviously doing that. We have one other question, and we'll wrap it up because we're at about 20 minutes here. It's another one from Nick. And thoughts on target date funds?
I think they're great, especially if, sorry, did you have something else to say?
No. I was just reading his other stuff.
Oh, okay. Target date funds are great. Basically, they're more, they're not high risk, but they're, what's the word that I'm trying to look for? They take on a little higher risk when you're younger. Nothing dangerous, but they're just taking on a little bit more risk. And then as you get older, a little less risk and a little less. So it'll move you out of mostly stocks, more heavily into bonds as you get older and older, because the theory is, you don't need to be in high risk stocks or high growth stocks when you're 60 or 70. So you hopefully by that point already made the money you're going to make. And then they can just move it into safer stuff like bonds, where you're earning a little bit of interest, but you don't really need to be earning money anymore. So target date funds are great.
I think that's segues into his next comment. He said his dad is in that situation. He's a 55-year-old guy who was taught 30 years ago that a 401k would help him retire, and now it's been cut in half. In my perspective, when I see that, I say he's still got 10 years left before he's going to retire probably and do anything. I imagine the market's going to have ups and downs in that 10 years anyway. So I wouldn't sweat this too much. I don't think we're going into like a 10-year, everything's going to zero. But it's never fun if you're watching it. It's definitely a rough ride. I imagine the people in 08, did not have a good time with that at all. So
yeah, that's the thing. Like, the perspective really helps to say, like, I get a lot of comments from people saying, I just started investing last year and I've lost all this money. It's like, you know what though? Like, people said the same thing in 2008. I'm sure people had just started investing in 2007 and they were enjoying it. And then everything, the rug got pulled out and they lost a lot of money. But zoom out and you'll see that like the markets have gone up so much since 2008. And the same thing will happen. There's always the doomsday people who say stocks are going to zero, but never happens. And by the way, if the stocks do go to zero, you're going to have bigger problems. You're not going to be like running through the jungle with a machete going, I wonder what my Apple stock is. It's going to be really
That's a really good point. Yeah, no, I think it also comes down to kind of what we were talking about at the very beginning. You know, when we're talking about investments and making good investments that are going to be good plays long term, and it ties right back into, if you do your homework and you due diligence, you're only maybe putting a little bit of money in the highly speculative stuff that can go to zero, because there are some things out there that are like startups or cryptocurrencies that are startups. Essentially, that's what they are. They go to zero all the time. It's going to happen too. So you can't be like all your eggs in that basket and think that's a good long-term play. You know, I tell people all the time when it comes to like cryptocurrency that people label me a Bitcoin maxi, because I don't get into a lot of altcoins. And the reason I don't is because I'm just like, look, you can't have a large portion of your money in like the highest speculation that there is. So 80% of my money in terms of, investments in crypto is in Bitcoin. And people think that that's stupid. And I'm like, you guys are just being greedy. You guys want the boom or the bust. And I'm not really here to play for either one of them. I don't care. You guys can play that game. And if some of you get rich, great for you. But a lot of you guys are going to not get rich, because that's how the game works, unfortunately, in that scenario. So just make sure that you guys are kind of like adhering to what he just said. Start with like an investment fund or a blended fund, whatever it is, as like the SPX. Those are things that I would say relatively low risk in comparison to like going out and investing in a new startup, for instance, and trying to handpick all the companies yourself that you think are going to be winners. I think that's something that you've probably, I would say, got better at over time. Even, it's one of those where I think everything takes a little bit of practice, and that includes evaluating companies and things like that. So
yeah, absolutely.
Okay. Well, I don't have any other questions. Max, do you have anything before we hop off?
No, good.
Awesome.
I've subscribed, so I'll just ask him in his comments from now on.
What's that?
I've subscribed to him, so I'm just going to ask him in his comments from now on.
Hey, he loves air fryers. I'll tell you that right now, and pro wrestling. So you've got those two things down and you're good. But Kenneth, I want to say thank you for coming on. Really, really appreciate it, because this is a segment that I think that our channel is lacking, and you fill that void on your channel so nicely. So make sure you guys follow him on all his socials. They are down below, and we will catch you guys in the next one.
All right. Thank you for having me.